So the market is, 30 points higher. There is enough action as far as stocks are concerned. The advanced decline ratio is slightly better than declines. There is detail on the CAG report on Rafale, which has been tabled in the parliament, which is coming through. And this is what the CAG report is pointing out. And I think this will be the biggest political story of the day by far. The CAG report says the Modi government's Rafale deal is 2.86% cheaper than the UPA deal. That is the CAG's finding on the Rafale matter, which, I mean, the report has been tabled in Parliament, and I think that is the key takeaway. The big issue, the big controversy has been, of course, how the price per aircraft rose significantly under the new deal which was negotiated by this government. And I think these are visuals which are coming out from the Parliament, from outside the Parliament. And you can see the Congress leader, Rahul Gandhi there, and other congressmen. You can see Sonia Gandhi there protesting outside the government. But, you know, the CAG in its report is finding that the Rafale deal, the Modi government is, just about 3% cheaper than a UPA's deal. And this will come as a big boost for the government and government votaries who've been maintaining all along that there's been no wrongdoing. Of course, expect a dogfight on this through the course of the day, and I guess through the course of the next several weeks, all the way leading up to elections. I don't think this issue really disappears, even with this report now coming through. Manish is here joining in with a roundup of all the commodity and currency market action. Manish, good morning. What are we focusing on?
Prashant, thank you so much for that. Well, it is the metal space that you need to keep an eye on because, the major talking point in the global markets, which seems to be moving the asset classes, really has been the US and China trade talks. The two-day conversation begins on Thursday and concludes on Friday. And on the background of that, you have the US president softening his stance, saying that he could push the March 1st deadline if the conversations are on the positive side. And we have seen some risk appetite, return because of that. You have seen the US dollar decline. The equity markets ran up. Many of the base metal prices also are doing well. But while we are looking at the non-ferrous metals doing well, it is the iron ore and the steel prices which yet again have seen a decline coming in today. There are reports of negative margins at China's steel mills. The rising iron ore prices have put pressure on the steel producers. And even as the iron ore prices are up nearly 15% in the month, we still are looking at some profit taking that we have seen in the last couple of days coming in for the iron ore prices. To talk further about that, we are now joined by Rohan Kendall of Wood Mackenzie. Rohan, hi. Thank you so much for joining us. Even before we start talking about specific iron ore and, of course, what's happening with WAIL, what is your sense overall on US and China trade talks? I mean, that's going to be an important talking point for this week now.
Yeah, it is, and it's a risk for steel markets. It's a risk that we've been flagging up for several months now. We have had some concern over the future growth of Chinese steel demand, and any uncertainty with trade tensions just adds to that risk. And now the steel industry is also facing extremely high iron ore prices on the back of the Vale dam disaster. Ultimately, this may lead to some demand destruction from the steel sector. Could be the end result of this.
So let's talk about Vale in a bit of a more detail. And the expectation is that nearly 70 million tons of iron ore output could see a cut coming in because of Vale shutting down some mines and operations there. What is your sense? Is that in the prices now? Have the markets overreacted? How big is the number, and how much of an overlasting impact do you see that on supplies and prices?
We estimated in a report this week that if Vale were to lose 50 million tonnes of production this year, then iron ore prices could be sustained at $85 a tonne. If Vale's losses were to reach 75 million tonnes, then that could sustain iron ore prices above $100 a tonne. So given that iron ore prices are in the high 80s at the moment, with somewhere between around 50 and 70 million tonnes of lost production, that feels about right to us.
And Rohan, how much of a sense would you take from the US and China conversation? I mean, it's been going on for a good part of last 8 to 10 months now. Would you see that the kind of slowdown that we have seen come in because of that, if there actually was a resolve that could be coming in next week or 10 days or until March 1st for that matter, would you see the demand then come back? Do you see many of the metal prices then see strength because of this?
It would certainly be a boost to the steel sector, no doubt about that. That would be a positive. I think really it's the Vale issue that's driving the market at the moment, though. That's the most pressing near-term issue. And no doubt the steel industry will be looking at ways to counteract that, potentially by looking to increase scrap usage in steel plants. We've seen Chinese scrap usage had dropped off a bit in the last few months of 2018. So there is some scope for Chinese steel plants to boost their scrap usage to try and offset some of the higher iron ore prices. And actually, scrap prices relative to iron ore prices are at their lowest point for some time. So we expect some of those substitution areas where steel mills can substitute out of iron ore towards scrap. We think we'll see that starting to emerge.
All right.
Okay, all right, Manisha, as well as Rohan, thanks very much for joining in and giving us that perspective.